Grow your practice, grow your wealth, grow your impact. Find out how to spend less time in the dental chair and more time on the things you love.
Welcome back to the Dental Wealth Podcast. With me in the studio, as always, is the Mr. Magnificent himself, Eric Morin.
You know, I was thinking the other day that Barbara Corcoran gave Mr. Wonderful that name. I didn't know that. I thought that was something he coined himself.
Really?
Yeah, that's what I thought. I thought it was something like he had coined himself, but no, it was from Barbara Corcoran. She actually made that up on the show, which I didn't know. So
I'm good at nicknames, so that works in my favor. I see a trend here. Posted all over your website, like everything. The Magnificent Eric J. Morin.
The Magnificent. I sound like a magician or something.
Right. Speaking of magic, what about a bank disappearing in the marketplace? I think
that's like was that a soft intro? That was like I don't know if that was a smooth segue, but I like it. I like it. The
podcast you've been waiting for.
It disappeared.
Yeah. Yes, there's a lot of craziness going on in the marketplace. I think SV is SVB, right? SVB. Ultimately is gone, and there's like a bunch of noise in the marketplace. So for our audience members that kind of have an idea, but it is kind of a difficult thing to grasp. But I know you have a good handle on basically everything that's business related in the marketplace. So what's your take on it?
so much.
It's so much to unpack.
It's so interesting because even in dental, with all the private equity firms moving in, it's so interesting because and I'm going to tie this back to Silicon Valley Bank in a moment, but I think with all the private equity coming in, people think, well, this is big Manhattan money. They know what they're doing. They're sophisticated, and there's a lot of DSOs that went under. I was just recently told about the story about a DSO that went under, and the truth is that and it's why I talked about in this podcast that there's like private equity 1.0, and then now we're like 2.0, and there'll be a 3.0, but not understanding the revenue cycle. And this is why this ties into Silicon Valley Bank. So, I saw a post on LinkedIn the other day by a mole, and it said something to the fact of, what can companies do to prevent this type of thing in the future? And, I started thinking about that for a moment, and it's the same thing that happens to any business. So if you guys don't know what happened to Silicon Valley Bank, the short version of this story is they had a heavy bond portfolio. And so the bond portfolio is at a low interest rate. And the problem with low interest rates on bonds is that when interest rates go up, so if Matthew is issuing me a bond and at current interest rates, it might be bearing 5 or 6% versus 1, 2, 3%. So for you to sell that bond ultimately at 2 or 3% or whatever, you have to discount the bond. So the way it works is that Silicon Valley Bank had a heavy amount of portfolio in the bond side. When the interest rates moved, they had to write off the bond portfolio. They took a giant hit on the bond portfolio. They also were in cryptocurrency and some other things as well. But the bond part really affected them dramatically. And it's kind of scary. But then what ended up happening was, and this is where it was probably an overreaction, they went to, so on their balance sheet, they took a loss on the bond portfolio. So when they took a loss on the bond portfolio in January, they had to turn around and basically with the way you get capital in a large corporation is you can do, just like you guys do, you can do debt or equity. You can have debt, which means you borrow money from a bank, or you can have equity, which means you use your own cash in your dental practice. Well, if you're a large corporation, you do the same thing. It's just a little bit different. You issue bonds, which is debt. You owe someone a fixed note, which is debt, and they have the first claim to assets, or you issue stock. And so stock is another way for you to gain capital. And so when they wrote off the bond portfolio, right, bonds, debt, they ultimately took a hit. And so what they did was they turned around and they said, we know we took a big hit on the bond portfolio. We are going to issue shares of stock so that we can get more capital to pad our balance sheet, ultimately putting more money in the bank, because it cost them a lot of money on that bond portfolio, a lot of losses on that bond portfolio because of the movement in interest rates. And so because of that, what happened is all of a sudden a lot of venture capitalists went, oh my gosh, I mean, this bank just lost a whole bunch of money and now they're having to issue and dilute share price and value, and they're trying to issue all these shares to ultimately get more money, which means they're in trouble.
Yeah.
And so all the venture capital firms started pulling money out simultaneously out of the business. And when you have a run on a bank, basically the way it works is banks only have to keep a certain percentage of reserves aside. So for instance, I might have $1 million in just simplicity, but I only have to keep $100,000 actually cash on hand, but I can act like I have $1 million because I have $1 million in deposits. So, and then what they do is they loan the 900 grand and then they have the 100 grand as reserves. But if everyone wanted their $1 million right away, they don't have it. They only have 100 grand because the federal reserve requirement only makes them keep so much. So when everyone said, I want my money, they didn't have it, they became insolvent. Ultimately, the FDIC only backs you up to 250, but Biden got involved and decided to cut everybody a check. So they're probably going to settle it all out and take care of the investors. And which is probably has more to do with lobbyists who got him into office than anything else, because out on the West Coast, you have a lot of that. So look, I mean, what does that have to do with dental? What does it have to do with Dental Wealth Podcast? By the way, some of you already know what I'm talking about. Some of you don't. I watch the pundits. A lot of them don't understand how this works. And so I'm trying to give you a brief explanation just so you kind of understand what happened. Yeah. And if we go back down to it again, it's the same thing with the mortgage-backed security crisis of 2008. I remember being with SunTrust, which is a large regional bank, which is now Truist in the Southeast, back in the early 2000s. And, in the banking side of business, people said, why would somebody lend why would somebody have lent the way they did back in 05 and 06 and 07? Well, because we were in a competitive environment, and ultimately the CEO's job is to provide value to the shareholders. And if you had told a real estate agent 10 deals in a row, you're not going to do the loan, but everybody else was doing it, you wouldn't get business. And so we can blame the executives and say they made poor decisions, but it was market pressure that ultimately caused them to make those decisions, and the rest of the market was doing it. And so they jumped in. My point of saying that is this: when we go away from fundamentals, when we move away from fundamentals, whether it be from market pressure, whether it be from poor executive decision-making, whatever it ends up being, we tend to get burnt. And we see it. It's so interesting because, by the way, and I'm going to pull this back into the dental space, but we see this happen in crashes and companies that fall apart. And it doesn't matter what's in the auto industry, the banking industry. We see when companies move away from fundamentals that they fall apart. And that's what happened. Ultimately speaking, this bank did not prepare for interest rates to rise heavily, even though we've known for a decade the interest rates dropped down to like nothing back in like 11. So it's like a decade of sitting there with low interest rate environment and not making decisions, knowing it was coming. Like the whole winter is coming. I mean, 2000, we were before COVID saying this at our lectures, at our workshops, is, hey guys, like this, there's economic things coming and you need to be prepared. And so companies, and individuals for that fact, spend and make decisions based on the fact that they assume that economic times will never change, even though we know they will. They buy things that are overpriced. They get too low on cash reserves. They make decisions, and then those decisions are very costly over time. We saw this when private equity first moved into dental, because what happened was a lot of them, especially this whole multiple and EBITDA conversation, a lot of these companies did not understand the revenue cycle and the continuity of that revenue cycle within the dental industry. Because they didn't understand the continuity of that revenue cycle, they lost a lot of money. And they didn't realize, hey, if the doctors and hygienists leave, there is no dental practice. There is nothing left.
We're in trouble. There's not many producers. I mean, I think it's like taking the whole sales department and being like, all right, what do we do now? You have a bunch of operations people and you have no one that's able to produce, and then you kind of left there sitting. And I think I was talking to someone that came to our foundation workshop this past time who owns a management company, and we were having this conversation about how a lot of we're seeing in the marketplace some DSOs go under. It's because they're over leveraging. They're not, they don't know what that revenue cycle looks like. And I think, we've talked about it on the podcast a lot, where we see it all the time. Right now, there's people that, if we go back to your 5 phases of wealth, there's a lot of risk takers right now. There's a bunch of people that are risk takers, and they're trying to ultimately get to the next point, but they're lingering in the risk taker. And eventually it's going to happen to them. Their knees are going to get cut from underneath them. And then this is what happens. And then you have to have other people bail you out. And that's what we're seeing with the SVB thing is bailouts.
It's interesting. I got a phone call from private equity. I get these calls occasionally, but I remember this one phone call. It was about maybe a year and a half ago or so. And I get this phone call from private equity. They reached out to me through LinkedIn channels, and they said, "Hey, we'd love to talk to you for a few minutes." And they said, "We'd love to have an hour phone call with you and just discuss. We're looking at entering the marketplace. We'd love to learn more." And I said, "Okay, I will take the phone call with you. It's $5,000." And the private equity company said, "Well, we only have $750 in our budget." Now, hold on for a second. $750, but you're about to make maybe a 30, 40, $50 million play. And yet you want to spend $750 and you get what you pay for. And they go, "Well, we have somebody that said they would talk to us for $750. And I said, "Well, then you should talk to them, because I'm not going to talk to you and give you advice for $750 for an hour. I'm not doing that."
That could make you
right.
$30 million.
I'm going to go make you a gazillion dollars, and you're going to pay me $750. Go fly a kite. So, that's a great example. Yeah. I mean, you got a private equity company who's not even willing to invest into people who can truly help you make strong financial decisions because they want to save a few $1,000. So, when we get into fundamentals, and that's what happened in SVB, is that fundamentals, it's the chasing thing. It's funny. I was watching this story about Bitcoin yesterday, and it was like, Bitcoin is at its back up to 28, 29. And I'm like, well, of course it is. Like, it goes up, it goes down. Bitcoin is here to stay. And you could have bought it at 18 grand, and you'd probably make about 10 grand in the last few months. Okay. We go, well, why didn't you buy it at 18 grand? Well, because you were scared. That's the whole problem. It's hard to buy things at the bottom because it's scary, because you don't know where the bottom truly is. If Bitcoin could have went to zero, and none of us would have been surprised. But that's the whole thing. But we know fundamentals, and we can talk about the fundamentals behind Bitcoin, but then we'd have to create a whole Bitcoin podcast, which we're not going to do. but the whole thing is that in business and life, there are fundamentals. Business is actually quite simple. People make it overly complicated because they put emotion into it. Yeah. But it's not that complicated. We know certain investments strategically placed in a certain order have the same consistent result over a period of time. It's actually not even that difficult. The difficulty, I was in my daughter's class this morning, Matthew, and I took a picture of a sign. Mm-hmm. It's pretty good. I thought it was pretty good. So I took this. So I was like, man, this is a pretty good one. Like, adults need to hear this. Uh-huh. This is a third grade classroom, by the way. And it says, sometimes it's what you learned in third grade is what you need to apply into adult life.
Back to the fundamentals, baby.
It says, minds are like parachutes. They only function when they were open. I thought, man, God, how many adults need to like post that up in their own office? And I thought to myself,
send that picture to Reese so he could put it up on the podcast.
It's beautiful. I mean, and kids, by the way, this is like probably lost on a third grader, right? It probably is, because they're like, huh? And they, but this is probably should be posted in every office, that minds are like parachutes. They only function when they're open. What I mean by that is, and what does that have to do with SVB and dental? Yeah. Because the biggest mistake people make when we avoid the fundamentals is because our parachutes are closed, and we think that we know all the answers, and we think we're better than the laws of economics. We're better than the law. Like we're the ones, right? The guy who thinks he's going to go to Vegas and beat the house, consistently.
Watched a bunch of YouTube videos like, I'm going to win $1 million.
Right. I mean, it's like, if you go to Vegas consistently, you're gonna lose money. That's just the way Vegas works. That's how they build those big old casinos.
Yeah.
When you have a business, you can follow the fundamentals. And here's the thing. Sometimes following the fundamentals are scary.
Yeah.
Sometimes you might lose opportunity. But we know that when we follow those fundamentals, and look, I think that part of being a business owner is taking risk. I mean, but make no doubt about it, but calculate risk. I mean, one of the things that Jim Collins talked about was this idea of productive paranoia, and that from good to great, the great companies had productive paranoia, which means the CEOs always asked, what if, what if, what if, what if? And here's what did not happen was at SVB. Nobody said, what if? What if interest rates go up and cryptocurrency goes down simultaneously? How in the world in a major bank did leadership not sit in a room and just simply say, what happens? Well, here's the problem. I'll guarantee you the damn CFO did. I'll guarantee you there were people in that office that said, hey, but somebody probably thought that I can go past the fundamentals. And here's the thing. And what happened was they were at the craps table.
Yep.
And they kept hitting 6 and 8 and maybe some hard 8s. And they were kind of, they were banking, and all of a sudden somebody went, boop, 7 came out. Right. And they were like, oh man, I'm out. Right.
Yeah.
And they lost it all because they did not, because their mind was not open enough to listen to the fundamentals. Someone thought that they knew better.
Yeah.
And they lost.
Yeah. I mean, I think we see it all the time. I think fundamentals is something that we preach about. Is basically, if you have great fundamentals, everything can happen in the marketplace and you'll be able to revert back to the fundamentals. I think with everything that's happening right now in the marketplace, there's a bunch of noise. There's a lot of people pulling out of certain obligations that they've had. They're trying to, hoard cash because they're watching CNN and Fox News, and it's doom and gloom and all of these. And we always stress, if you just focus in on your fundamentals, you're going to be fine.
That's right.
Go back to it and say, how am I taking care of my team? Am I marketing? What does my capacity look like? Do I have a hold of my financials? Like, the fundamentals of running a business is what everyone that's listening to this podcast should be focused on right now. They should not be focused on, everything that's crazy in the marketplace right now, because if things do happen and things do get bad, guess what? You'll have your fundamentals. You'll have everything in place already. It's the ones that don't have that stuff in place that are going to suffer. But the ones that have everything in place are going to be great. The ones that came out of COVID and kick butt and take names because they were fundamentally sound. I think, some of the greatest professional athletes in the world, all they do is focus in on fundamentals. So they'll go through a practice, and then after the practice, they'll just shoot in the gym, or they'll take swings in the batting cage just to focus in on their fundamentals. And like you made a great point saying, sometimes it's scary when you focus in on fundamentals, because a lot of times you'll figure out flaws that you have in your game. Like, when you go back to the fundamentals is when you start opening yourself up to, hidden things that you haven't seen before that's, causing chaos in your practice or your business. The great part is that's why you go to your fundamentals, is to fix those so that you future-proof the business. Because when things like this happen, having cash reserves, having your accounts set up, financials in place allows you to make moves when the marketplace takes a crazy turn.
When COVID happened, we've talked about on this podcast, when we said to invest in marketing during COVID, some people might have thought that was risky, but it wasn't. It was following the fundamentals of business. At that time, the acquisition cost per new patient was low. It was so significantly low that it made sense to invest, as long as you had enough cash, which we as a business, as a consulting firm, communicated to our clients to put cash aside, because we knew that the markets would have a shift within a few years. And so with the amount of capital, and because acquisition cost was so low, it was easy to accumulate patients at a much discounted fee during COVID. See, fundamentals work both ways. Fundamentals also allow you to zig when everyone else zags. And when they're freaking out, you can make very calm, wise decisions, because you're not beholden to the winds and the emotions of everybody else. Everyone knows that in real estate in 2008, you could have bought a lot of real estate for a low price. The problem is in 2005, you would have had to start putting some money aside, realizing that the real estate market was not going to last forever like that. When we follow the fundamentals, and that's what SVB did not do, they did not look at the fact of eventually the interest rates will change. Eventually, if you get caught in the whole cryptocurrency, it's going to turn back into one Bitcoin is going to be worth $1 million someday. I mean, it could, but odds are probably not. And so, when we know when our minds open like that parachute, I think the biggest thing, and Jim Rohn said it best, which is why I do a workshop and one person walks out and says, this was the greatest thing I ever heard. And someone else walks out and says, I've heard this all before. It's what he'd call the mysteries of the mind. How is it that one workshop changes someone's life and someone else says they've heard it all before? I'm telling you, because their parachute was closed, because they did not want to listen, and they thought they had all the answers. Because certainly if you've been to enough business seminars, enough workshops, enough things, you content, by the way, we learn through repetition immersion, but certainly there'll be some duplication in content. But it's that nugget, it's that piece. You got to go in there going, I'm going to grab something out of this 2 days that's going to change my life. I know it if I just listen for it and apply it. But when your parachute's closed, you can't hear it. Well, interestingly enough, the people that are the most successful, I'll guarantee you, whoever was running SVB had a closed parachute. They were not willing to listen. They thought they knew it all. They were riding the highs. Life was good. And ultimately speaking, they got smacked in the face. DSOs, I'm telling you, DSOs, there's so many of these guys are going to go out of business. They're going to get smacked in the face. There's so many people who do not understand. I mean, I just had so this is a text I got from a doctor yesterday, by the way. This came through. I want to read this because this doctor decided not to sell the practice to this doctor. He had multiple locations. He had this one location he was thinking about selling. He got a lowball offer. He didn't take the offer. So what came back was, with the current economy, should I reconsider selling to this doctor? He asked me to do so. What? Downfall in economy? What? Where is she experiencing a downfall, or he experiencing a downfall in the economy? Like, where is that happening that he's experiencing that? He's not experiencing that. It's in fact just making a move, not based on fundamental math, not based on concrete evidence, but ultimately by emotion. And that stuff happens all the time. People make poor decisions based on emotion instead of fundamentals and this amazing thing called math. Math is incredible. It's kind of black and white.
Especially in dental practice.
My son is he's phenomenal at math and he loves it. But when it gets like some of the liberal arts types classes, he's like, he's like, Dad, he doesn't, when you're math minded, you just, those classes you don't love as much because you're like, I gotta, there's a gray, right? It's whether the interpretation, the subjective criteria of whether your paper was good or not. A lot of it's subjective. I'm not talking about grammar, but I'm talking about the content within it and comprehension, which is different than science. Black and white. Business is black and white. Yes, there are some areas where we take calculated risk. There are some areas that, and by the way, investing in marketing during COVID was not even a calculator. It was just fundamentals. That was a fundamental. We could argue it was a calculated risk, but it was a very low risk. And the people who did it, boom, blew up. So in business, I would tell you, if you want to grow significantly, you understand and fundamentals are deep. And when you understand the fundamentals, I'm just telling you, I just opened up before this podcast, I just opened up a client file and, I looked through it. It was a doctor coming in and I looked at it and I go, yeah, this is all fundamental. This is all just fundamentals. And so that's the thing we have to understand, is that so much of this is is understanding the fundamentals. So the question for you is, do you have your parachute open? Do you know the fundamentals? And how can you apply them to take emotion out of the picture?
Yeah. Just stop listening to the marketplace. I think that doctor that you explained is probably watching too much CNN and not focused in on his business. I'm seeing a lot of people like call into Tower Leadership that are kind of in a, I would say in a nervous panic right now. And that should be flipped. You should be positive. You should be like, okay, so there's going to be a lot of opportunity in this marketplace. And I think that's what we always stress at Tower Leadership is you got to look at every opportunity that you get. When there's marketplaces that could take place, you got to be able to take advantage of it. So just like you said, jump back into the fundamentals, guys. If you're listening, fundamentals, start your day off with certain fundamentals in place. Attack your business from a fundamental standpoint. Have all of these in place and you're going to be just fine. One of the fundamentals you should do is, guess what? Like and subscribe to the Dental Wealth Podcast.
Fundamental. Just telling you, fundamentally, when you have great information, you share that information.
Share it. Make sure you get it in other people's hands. I think this is a great one. So if you have someone that, you've had conversations with them and they're kind of nervous about what's happening, this is a great opportunity for you to send them this podcast and say, you know what, why don't you listen to this? It might change your perspective on what's happening in the marketplace. So like, subscribe, share. As always, if you guys want us to touch on a certain topic, concept, anything like that, you can always comment on the social media channels. You can send a message into info@Tower Leadership and we'll make sure you're getting taken up. So thank you so much, Mr. Morin, for joining us today, and we will see you guys next time.